lot of people are really nervous about investing during an election year. It's an unprecedented year. We have coronavirus, we have civil unrest, and then we layer on top of that the fact that we're gonna elect a president in November. So in today's video, I want to talk about a few factors that are unique to 2020 and also some historical perspective to give you some insight into what is it actually like investing in an election year. I'm going to talk about the trends and what you can expect going back almost 100 years. And then I'm going to hone in and talk about one thing you definitely don't want to do in 2020. So really the goal today is to just share with you some perspective to help you navigate one of the most uncertain years in recent memory. Hi there, my name is Ashley Micciche. I'm the CEO of True North Retirement Advisors, where we specialize in retirement and exit planning for business owners. The first thing I want to talk about today is some historical perspective and go back to the 1930s and look at what actually happens to the stock market, to the economy in a typical election year. I think this is really important to do this because if you understand what a typical election year looks like, it helps you to keep your cool. If you go back 100 years, would you be surprised to learn that in a presidential election year, the average return is actually positive? So a lot of people, I think, are really surprised and taken aback by this because of all the uncertainty. The stock market actually does not react very strongly to what's happening in the contentious political environment during a presidential election year. And then if you fast forward to the following years, what does that typically look like? Well, if the incumbent, so if the existing president is re-elected, the stock market return was about 6.5% in the year following that election. So that was the average return going all the way back to the 1930s. If a new president was elected, the returns were only slightly lower at 5.6%. But what tends to happen is that, especially as the election approaches and then after the election, it's pretty muted because we get this sense more and more, especially when there is certainty after the election, of what that political environment is going to look like over the next 2 to 4 years. Every single presidential election cycle, I have a client or two that completely abandon their long-term investment strategy and they go to cash. They're just so nervous and so fearful about what lies ahead that they just want to keep some powder dry, go to the sidelines, wait and see what happens, and then jump back in. But truthfully, if you are a student of investing, if you are serious about building long-term wealth and protecting yourself and your portfolio in retirement, that is the worst thing that you could do. So the one key takeaway about 2020 is that yes, it's a year of incredible uncertainty. We don't know what the future holds, but we never know what the future holds. And so you can't abandon your long-term investment strategy, sit it out, go to cash, and wait for things to get better. Because inevitably what happens is that you cash out at the wrong time. And so then what you end up doing is you lock in those losses at that low point. That's why I talk about the historical perspective, because if you have the historical perspective in mind and you're like, okay, the stock market tends to do well in an election year, the uncertainty of the election isn't that big of a deal. And then even with everything else going on right now, the stock market, we're halfway through the year, the stock market has been pretty stable despite coronavirus, despite all of the unrest, despite the presidential election year, which just proves my point further that stock market returns tend to be pretty muted in an election year, and in the year following tend to be positive as well. So there's no good reason to abandon your long-term strategy for retirement, for your investment portfolio, because of the turmoil and political uncertainty that exists right now. With that in mind, the historical perspective and the fact that you shouldn't abandon your long-term investment strategy, it's not a time to just bury your head in the sand and ignore everything that's going on out in the world right now, because that is also a mistake. So the prudent path is somewhere in the middle. What are the things that are likely to change if Trump is no longer president? Now, this is not meant to be some sort of a political or biased discussion. I'm just talking about the facts here, because the fact is that whether you like Trump or not, he may not be president come November. And we are already have a lot of insight into what Biden is campaigning on. So we can kind of make some educated guesses about if Biden wins the presidency, and especially if there's a change in Congress, there are a lot of likely potential changes coming. And as it relates to policy, regulation, etc. And that has ripple down effects to your portfolio. So I want to pinpoint and talk about a couple of these things. So the first thing that you'll really want to pay attention to is the incredible environment that exists right now in 2020 as it relates to estate taxes and gifting. The rule of thumb here that I want you to pay attention to is that if you are wealthy, now is the time to gift. If you are planning to give business assets, real estate, investments, the gift and estate tax exemption is so incredibly high. It's never been this favorable before, and that's likely to drop back down substantially. Taxes in general, most people just think about like income taxes or maybe capital gains taxes, but also estate and gifting as well. So that's super important because you can't just like snap your finger and do that overnight. A lot of times that requires some planning. The time to start is now. If you need to do some things to kind of clean up your estate, make it more tax efficient, and do some gifting now would be a good time to look seriously at doing that before the clock runs out if Biden is president. Now, of course, if Trump is reelected, then you probably have some more time. But if you think about it too, taxes, it's hard to say. Like, taxes are difficult to predict in general. Aside from higher potential taxes, if somebody else is in the White House next year, I think it's really important to pay attention to policy and regulation. Again, Biden has already been campaigning on these things. So if you just listen to what he's saying, like what he's targeting and what industries might benefit from a Biden presidency and what industries or companies might be hurt by that. So a couple of areas that come to mind is A, you want to be very careful that you understand how regulation and policy might change under a change in presidents and a change of administration. You know, whatever that industry is, you want to pay attention if you have a high concentration, a high percentage of your portfolio in any particular company or any particular industry. You need to know how a change of control politically is going to impact your investment portfolio and take action today as a result. So maybe that means trimming things back. You don't necessarily have to liquidate it all together, but you want to be careful that you're not blindsided or, you know, like sucker punched if and when there's a new administration and they decide to target the industry or the company where you have a lot of your retirement assets. So in general, it's really not a good idea to have a lot of your net worth tied up in any one particular sector or industry, especially in any one particular stock. But a change of political winds in an election year gives you a really good excuse to seriously evaluate that and look at how you might be exposed. So just to recap, I talked about 3 primary drivers that you want to pay attention to during the election year. First is historical returns. If you go back almost 100 years, the stock market actually does pretty well in an election year and in the year following a presidential election year. The biggest mistake that you can make, which is point number, is to abandon your long-term strategy. And then lastly, find a balance between, yes, we don't want to abandon our long-term strategy, but we don't want to bury our head in the sand either. There are a couple of areas that are vulnerable if a new administration is in the White House. So if you have a higher concentration in a certain industry or a company that's going to be impacted by increased regulation or changes in policy, you want to pay attention to that and take action now. And then the other thing is taxes. It is all but certain that if Biden is president for the next 4 years, that taxes are going to go up. And the gifting and estate tax environment right now is incredibly generous. All right, thank you so much for watching. If you like this video, be sure to check out my podcast, The 1 Minute Retirement Tip, where I deliver quick daily tips to help you on your path to and through retirement. And also be sure to like and subscribe to this channel. Thank you so much for watching. My name is Micciche, and I hope you have a blessed day.